Okay, so we're back live for the seminar. There's one question here from the last. Bradley just asked a quick question on: are you guys advocates of paper trading or real life trading with very small size? Here's the pros and the cons of paper trading. The only pros of paper trading are that you get to learn the software, and you should do that for a couple of days just to make sure that you're familiar with the software. But anybody who tells you that you should paper trade a strategy until you get comfortable with it and then you can start making money with the strategy has no clue what they're talking about, because what happens is that paper trading a strategy is very easy because you have zero emotions on the line. You've got to figure out how you're going to react under the real stress of having money on the line, because on paper trading you're not going to know that. And literally 60 to 70% of the battle with trading is being able to control yourself when your emotions start getting all crazy, if they do. So paper trading is good for learning the software. Otherwise, you need to get out there and throw real money on the line and start learning about, if you've never traded before, learning about how you react to different situations, learning how disciplined you are. You're not going to get that sense with paper trading. And paper trading can give you kind of a false sense of security too. So that's my thought on paper trading. You got to get out there as soon as possible in the real world.
Yeah, I agree. Paper trading is good for learning the actual software, your execution platform. I recommend you do it for, a week or 2 weeks for people that aren't computer literate, just because you want to know how to you just need to know how to use your software in case something bad happens. It should be automatic. It should be, like Pavlov's dog, ring the bell, saliva, eat the food. When you see a signal, you should be able to, in half a second to 2 seconds, you should be able to execute a trade. If you can't, you're doing something wrong. And the one thing you're going to find when you go from paper trading to real trading is your paper trading is going to just be, you're going to be on fire. You're going to be the man paper trading. Then when you go from paper trading to real trading, all of a sudden you're going to be second-guessing yourself. There's going to be a little lag time there because you're going to be like, oh, that's a squeeze. Well, here, let me see if I can, let's wait for a confirmation here. And the lag time, it's where you're analyzing what's going on. It makes you second-guess yourself, and about the time you figure out that it's a good trade, it's halfway over. So that's my thoughts on paper trading. Paper trading has its advantages, but it's really just, like John said, just to get trained on the software so that you know how the software works, to execute it, to train your eye to like patterns and stuff. It's more or less, it's like a boxer. You just want to be able to bid, ask, buy, sell, close, open, short, cover, stuff like that. But as far as actually building up wealth and making, building up income stream, it's worthless.
All right, so what we're going to do now is we're going to talk about intraday indicators. This is, and by the way, what we're going to do is prior to going to lunch, we need to get through intraday indicators and gaps. It may be close to 12, but we may run a little bit over, but we want to get that done before we break. So what we're going to do is this next section is one of the shorter sections in this workbook, but it's by far the most important. So please feel free to ask questions. You guys have to understand this if you're going to make the rest of this stuff work. Okay, that's how important this is. So let's talk about the intraday indicators. Basically, where both Hubert and I have our expertise is that we can read the markets pretty much better than anyone else we've ever met. There's other people out there that can do things better than we can in terms of trading, but we're really, really good at reading the market in terms of which way the market is going to go, and this is why. And this is just from basically watching this stuff every day for, years and years and years and years. And what we've done is we've put together just kind of a checklist of each of these to understand how all of these work. And so this is what we watch. We watch the ticks. If you don't know what any of these are, there's the definitions right beside it. The ticks measure the net buying and net selling on the NYSE. We look at the ticky, which measures the net buying and net selling on the Dow. Now, there also is a TickQ, which measures the net buying and net selling on the NASDAQ. I have actually not found that to be a very, powerful indicator, so I just stopped watching it because I found it didn't really make a difference. If it was going to happen in the TickQ, then it was also going to happen in the tick and the ticky, so it was just kind of redundant. The put call, which measures the ratio of calls versus puts. By the way, there's 3 put calls. There's a index put call, there's an equity put call, and then there's a combined equity index put call. And so what we're watching is the combined equity index put call. And then there's the TRIN, which measures the up-down volume on the NYSE, and then the TRIN-Q, which measures the up-down volume on the NASDAQ. And then finally we have what's called the sector sorter list, which measures the sector performance and overall market strength or weakness. Okay? So now we're going to go through each of these. And these are short and sweet. Alright, so here's the ticks. Okay? This is, on the ticks, what we're looking at, it's basically, it's a simple 5-minute chart. The key thing on here is one of the key things that we do that gives us an advantage is that we mark the key levels up here. And so what we'll do is we're going to put, you'll see these horizontal lines on our chart on Monday where we're going to have marked like a line across here at these key levels. So we do this at 600, at 800, 1,000, and 1,200 ticks. Okay? We also do the same thing down here. You can see there's a line at minus 600. And we're going to do this at minus 800, minus 1,000, minus 1,200 ticks. And what we do on these is that the idea is that anything basically in between these levels, in between these extreme levels, is just what we call noise or static. It doesn't really matter what's happening. What we're interested in is the extremes. And so what I do on these is if the markets come up to 600 ticks, I've got an audio alert on all these lines. And what will happen is that, if we get up to 600 ticks on that, we'll be able to hear an audio alert, whether it's it's a noise of we've got one where it's Austin Powers yelling out, "Hey, this is hey baby, this is what's going on," for the alert. If it gets up to 1,000, we'll hear a specific audio indicator for that. And by doing that, we can sit there and we don't have to stare. We don't have to stare at the computer, and we'll know what's going on.
All right. John's grabbing some audio files here, so we're going to give you a couple examples of exactly what we listen to when it's hitting 600, 800, and 1,000 ticks. Another little tip I'm going to give you guys is John likes looking at the tick like this. He'll use this, usually 5 and a 15, John, right?
Yeah, 5 or 15.
A 5 or 15. I like looking at it on a 2-minute chart, and I use the old-fashioned, just a line-on-close chart. But I'm more of an intraday scalper, okay? As soon as I see the ticks hit, and it gives me my sound, and then also I want to see the first little TP just hooking over. And that's a really good tick extreme fade type play. So I actually look at it a little bit different than John. And you won't know. The best way to do it is at the end we'll send you guys some TradeStation layouts of the way John looks at the market and the way I look at the market. And then what you can do is if you like John's, keep John's. If you like mine, keep mine. If you want to mesh the two and go, okay, I like this, that, and this part of John's, but I like this and this of Hubert's, and then we'll throw the rest of it away, that's fine. We have no problems with that at all. But I like the lines just because the lines will give you a good visual representation of, okay, it's 1,000, boom, it'll hit right there, and then it'll roll back over, and you can just see the hook happening, and you'll be like, okay, it's fading. And then I'll watch the trend and the actual price action and time and sales for an entry to the downside. Okay, so here's some sample sounds of what it sounds like when TradeStation's going off at the different levels.
You can put on there. So what I'll do here, this is just some examples. So like what I can do is like let's say I'm out, I'm on the phone or I'm in the hallway, and then at noon I'll hear like plus 600. The market hits plus 600 ticks. Well, I want to know that, so this is what I'll hear. Okay, so if you guys heard that, was like it was like a Homer Simpson going, making his noise. So now I can sit there and I can, if I'm on the phone and I hear that, I will know that the market is, up 600, up plus 600. Now if I hear, I want to know if the market gets up to plus 1,000. Here's a sound for that.
You don't have to be crazy to do that, but it sure helps.
So, there's a couple of different things like that, and, we've got some of, let's see, there's one here that, if the market gets down to, minus 800 ticks.
Don't worry, I'm not going to hurt you.
I always crack up whenever I hear that one. And then, let's see, there's another one, if the market gets down to 1,000 ticks. Let's see, I know there's one other one we hear. I always like this one on, like, plus 800 ticks. So what happens then is that instead of becoming just a visually dependent trader, you're now you're using your other senses to help you with your trading. And what's great is because there's other things that instead of having to stare at all this different information that's coming in and getting a handle on what's happening, you can sit there and focus, like, say, on your Dow chart and just look at it, and you'll hear in the background, you'll hear come through your speakers like the sound for minus 800 ticks. So you don't have to sit there and miss a trade because you weren't watching the ticks. You'll know exactly what's happening. I'll be in a trade and I'll hear the different price levels start firing off, and I'll know exactly what, we're going through 600 ticks now. That's great. That means we have a good chance of breaking through resistance. Okay, now we're at 800 ticks. Buyers are starting to get a little excited. We may push up to 1,000. And if we get up to 1,000 ticks, I'll know that we're about running out of power, or we're running out of steam, and that at 1,000 ticks, I want to start selling my position. Well, by having those audio alerts fire off, I don't have to sit there and stare at the tick chart and potentially miss a trade signal because I can hear them. And to me, it's like one of the most valuable things in terms of being able to gauge what's happening in the markets. Again, because you don't have to stare at the markets, you can be in the next room and you'll know exactly what's happening based on your auditory alerts on the ticks. Okay, so there's a question there. How do you add those sounds in the data feed? I use eSignal. That's a good question. All these that we do right now are on TradeStation. We will look at that and get back to you because I don't know if anybody else knows how to do it on eSignal. I don't know because I don't do it on eSignal. But we can look at that and check. So here's the rules then for the ticks. Okay. Basically, if you've got plus or minus 400 ticks, that's really noise and can be ignored. And if you even if you get up to like 500 or anything like that, again, it's basically it's not a big deal. If it does kind of get through 400, now you have the potential where you might make some bigger moves. But basically, it's just noise. Oh, great, Bradley. Okay, thanks. Yeah, I knew you guys in there that use the eSignal for the alerts. If you want to type it in there. Now, the reason this first part is important, okay, is that let's say that you get a breakout on the mini-sized Dow to new highs on the day, and the market's only like at plus 200 ticks. Okay, what does that tell you? That tells you that there are no buyers behind the move, and it basically means you're setting up for a false breakout. So what I'll do is on stuff like that is when I see moves, I want to see them confirmed by the ticks. If you see moves without confirmation by the ticks, you can basically it's a really high percentage of like failed breakout or failed breakdown play. So that's one thing I like to watch. You'll see us in the room going, okay, the markets are they're trying to head to new highs here, but there's no the ticks aren't behind it, or there's no buying here. Stuff like that. So that's where you just get markets that are testing levels. So how do you use that? That's when we'd set up like if you've got a rally to trying to make new highs and the ticks aren't participating, that's when you set up a new short. And those are some things that you watch there. So that way you don't get sucked into false breakouts and false breakdowns. Now, where it gets important is that when you get to plus 600 or minus 600 ticks, that's where it really gets important. Now, there's two things here where this is critical. Let's say you're in a trade on the Dow and your normal stop's 20 points or 10 points or whatever it is. For me, if I'm in a 20-point stop on the Dow and let's say I'm short and we get up to plus 600 ticks, okay, I'm going to hear my audio alert go off at plus 600 ticks and I'm still short. The market's telling me that I'm wrong. And instead of sitting there waiting for my stop to get hit, I'm going to go ahead and get out at the market. What this generally does is saves me about 8 to 10 points on a stop. So instead of getting stopped out on a full 20 points, I get stopped out at 8 or 10 points because the market has jumped up to 600 ticks. I know that if it's at 600 ticks and I'm short, I'm wrong. and this is a way for me to get out of my trade early. And it actually increases your risk-reward ratio. And it's a great way to kind of give you an edge in terms of the markets. Conversely, if I am long and now we get a plus 1,000 tick reading, I'll know that that's about the most the markets are going to give this move. I mean, they're firing all bullets, all pistons are going on all cylinders. There's not much more you can do than a plus 1,000. I mean, sure, every once in a while you get a plus 1,200 and the rare plus 1,400, but normally when you get up to 1,000, that's pretty much it. So if I'm in a trade and I haven't hit my target yet, and we get up to plus 1,000 ticks, I'm starting to sell my position. And what will happen quite frequently is in these instances is you're going to get up to a level and you're going to get out because of a tick reading, and that trade would have turned into a losing trade because then the markets collapse and go back down. Instead of letting that happen, you know that the market, this is all the market's going to give you, and you can get out instead of letting the market go back to your stop. And basically you're getting out as a profit if you're long. If I'm short, I do the same thing. If we get a minus 1,000 tick reading, and I'm short, and my target hasn't been hit yet, or I've just got an open target, when we get down to a minus 1,000 ticks, I know that we're getting extreme selling. We're not going to get much more than this, and I start taking my profits. So you can use, a lot of times people will ask me, we'll scale out of a position, and we'll go, all right, we scaled out of the first half for plus 10. John, what's your target for the second half? Well, a lot of times it's an open target, and these are some of the things I'm looking for. If I'm long and we get a 1,000 tick reading, I'm going to sell it. If I'm long, or if I'm short and we get a minus 1,000 tick reading, I'm going to sell. I'm going to cover it and get out. And so these are things that I'll use for exit strategies as well. We also have a trade strategy that we're going to talk about later, where we'll actually use a plus 1,000 reading to open up new shorts, or a minus 1,000 reading on the ticks to open up new longs. That's a trade strategy that we'll talk about later. And also on the ticks, you can actually read the tick chart almost like a market chart. You want to see if the market's going higher, then you want to see higher highs on the ticks. That confirms the move. If you don't, then that's a red flag that the market, rally probably won't last. All right. So that's everything on the ticks. I mean, this is a very important part. It's a real simple strategy. It's real simple rules that you want to follow on the ticks, but you just want to understand them. I'm going to jump into the next category here. If you guys have any questions on the ticks, feel free to ask them now. Hubert, do you have anything you want to add on the ticks?
One thing I'd add to the ticks, usually if you'll see a gradual build-up, if you apply the ticks with pit noise, it works a little bit better. You can, let's say you have an 800 tick, and then a 1,000 tick, and then a 1,200 tick. Pay attention to price action. If it's going to be a real move, when the ticks are at 1,000 and come all the way back down to 800 or 500, and price action does not follow, like let's say you have a tick, it hits plus 1,000, and then it goes from plus 1,000 to like 600 ticks, okay? And the price action moves a whopping 5 points on the pullback on the ticks. Obviously, the market's going to go long. So there are instances where the tick will just hang up there at 1,000, 800, 1,200, but that's more rare than when the tick will just explode to 1,000, and you can do a tick extreme trade to fade it and head another direction. That's one pointer I can give you. Anybody else have any questions on tick tips or anything?
I wonder why these aren't appearing over there.
Okay. Will you be
this one.
comparing the...
Here, I'll get it. Yeah, Justin, we're going to go over the 1,000 tick readings a little bit later. We've got a specific play for that. Malcolm. Yeah, I'm going to go over the ticky next. The ticky's different. You can use the ticky similarly. About the same for the ticks, but the ticks actually work better in some ways, and the ticky works better in other ways, and I'll show you. So let's just jump right into the tickies here. All right. Now here's the tickies. Now what the ticky does, the ticky just measures. It's the same thing as the ticks, except it's just measuring the net sellers versus buyers on the Dow. So there's only 30 Dow stocks. So if you've got a plus 30 ticky reading, that means all 30 Dow stocks are moving up at the same time. And by the way, that can only happen on buy programs. So that's why you want to pay attention to that. Roger has a question. Do you use divergence on the tick? Yes, that's one of the things that we look at is if the market is making, say, lower lows, but the ticks do not make lower lows. We'll look at that as a bullish divergence and look for the market to turn higher. That's stuff that we'll talk about too on Monday when we're doing the live trading. But we do look at divergences on ticks. Yep, no problem. On the ticky, it's not so important because what will happen here is on the ticky, the ticky moves all over the place all day like that, so the patterns in the ticky aren't that really valuable compared to the ticks. But where the ticky, the most important thing with the ticky that I use is, again, I will use the sound effects that we went over, and you can see here at plus 26, plus 28, and plus 30, I'm going to highlight these bars so that when we get up to plus 26, there's going to be an audio alert. Same thing down here, minus 26, minus 28, and minus 30. I'm going to highlight those bars so that when we get down there, there's an audio alert. And I'll use those pretty much in the same way that I'll use the ticks. All right? So let's go and look at the ticky rules. For the ticky, basically anything plus or minus 20 is noise and can be ignored, kind of similar to the ticks and plus or minus 400. When you get to plus 26 or minus 26, that is when you want to pay attention, because what will happen is that when you get a plus 26, that's a heads up that you got a buy program in place. A small buy program will say, you'll get a plus 26 reading. If it's a bigger buy program, you're going to get plus 28, and if it's a huge buy program, you're going to get plus 30. You're going to see this first in the ticky. This will tell you that there's a buy or sell program faster than any other indicator out there. The ticks will be more slow to respond. Why is that? Because in the NYSE, there's a couple of thousand stocks, whereas in the Dow, there's only 30. And in the Dow, anytime there's a buy or sell program, all 30 Dow stocks will be involved, whereas in the NYSE, it's not necessarily that all those stocks will be involved in that buy or sell program. So what will happen is, if you're long and you get like a plus 28 reading, you're getting ready to get a buy program hit, so you want to sell into that. If you're short and you get a minus 28 ticky reading, you're getting ready to hit with a sell program, so when the market drops on that, you want to start selling into that, start covering into that. Because what will happen is once the sell program's over, the market's going to bounce back pretty hard. And then conversely, if you want to do is if you're on the wrong side of the market, if you're short and you get a plus 28 reading and your stop's not hit, you get out. So it's kind of similar how I use it with the ticks, but the tickies don't really form any patterns. They're not really good with divergences. They're not good with forming patterns that can be recognizable like you can in the ticks. The main thing is that the ticky is faster than the tick, and I want to use these because I want to know when buy or sell programs are getting ready to hit. Did you have anything you want to add on the ticky?
You're probably asking yourself a question, why do I use the ticky for program buying and selling? The reason you want to know it is because more than 52% of the volume in the NYSE is traded by program trading. So that means we're trading against, more than 52% of the trading on the NYSE is done by computers. And I don't mean just electronic direct access. I'm talking about computers, just systems that they have designed to generate orders. When ABC happens, XYZ is what they want to happen. Okay? So you're trading against computer systems. The good thing about it is you can use the ticky to see when they're buying and selling, so you can kind of see their hand and you can piggyback off them, okay, for intraday scalps and stuff. And another good thing about it is 52% of it's program trading, but humans had to design the systems that the systems are actually trading in the program trading. So that's why you use the ticky.
Very good, very good. All right, so let's jump in here next to the put call. On the put call, basically, we chart the put call very similar, about the same as we chart the ticks and the ticky. I cannot say that word for the life of me today. On the put call, again, as I was talking about earlier, the put call, there's three types of put calls. There's the index put call, the equity only put call, and then the combined index equity put call. And what we do is we watch the combined equity index put call. And there's only a couple of reasons that we watch this. And let's go over those. On the put call, the first thing that we're looking for during the day is, do we have an extreme reading? Okay? And a lot of times in the room, you'll hear us go, all right, yeah, the markets are falling here, but the put call went over 1, so we're not doing any more shorts. The reason we do that is because once you get over 1, you basically have extreme bearishness in the markets. And if you think of it this way, okay, let's say there's 36 people attending this online seminar. Let's say that all 36 of us were bearish on the market. So if all 36 of us are bearish on the market, then
I'm going long. You 35 are screwed.
If all 36 of us are bearish on the market and we're all short, now there's no one else left to sell. So what's going to happen is that the market's going to stop falling, it's going to start ticking higher, and it's going to start taking out our stops. So those of us that have real tight stops will get stopped out first. Those of us that have medium stops will get stopped out second, and those of us with the wider stops will get stopped out last. And the market's actually going to rally, not because people are selling. It's because nobody is left to sell. So it'll start rallying just on the buy stops. As it hits more buy stops, it'll go higher, and so on and so on. So if you look at that as a bigger picture, if you've got excessive bearishness in the markets, then all of a sudden there's nobody left to short. The markets are going to start rallying because people are going to have to start short covering, or they're just going to get stopped out on the short side. It's the same thing on the long side. If you've got a put-call ratio of 0.50, then you've got too many people that are bullish. So same scenario. If everybody in this room is bullish and you're already long, there's nobody left to buy. And if there's nobody left to buy, the markets are going to start drifting down, and then they're going to start accelerating as our stops get hit. And those with the tightest stops get hit first, and that's going to move the market to the medium stops, which is going to move the market to the wider stops. So it's just a chain reaction. So you just want to be on top of that and know what the put call is doing. The other thing, I'll let Hubert talk about this, is just the trend of the put call and what that does. You want to talk about that a little bit?
Okay, here's a common sense. I don't trade options. I've done 2 options trades in my life, one good, one bad. You don't have to worry about the put call. Here's the common sense definition. If the put call is going, let me get a draw tool here. Hold on just a second. If the put call is going up, if the market's going up, you want the put call to be going up with it, okay? If the market is going down, you want the put call to be trending down with it, okay? Now, another thing that will happen is you will have a put call that opens up, let's say, 0.70. Let's say it starts at 0.70, and then it just goes dead sideways. That's like a neutral day. Like, when was it, Friday? Friday we had a real weird put call. It was up around 3, and then came down. It started at like 3.0, and then it came down to like 1.5, which is still really high put call. And then for the remaining part of the day, it went dead sideways. So it went from 3 to 1.5, and then from 1.5 it just traded sideways in a 1.5 range. Now, the good thing about this is think of it like this. Let's say you have a dam, and it has cracks in it, okay? And the more and more water is coming out of the dam. What the put call is doing when it's above 1 is there are people sticking their fingers in the cracks of the dam to stop the bleeding, okay? So the market may just trade in a sideways range or just slowly bleed, but it's not going to fall apart because everybody's sticking their fingers in the cracks and the holes of the dam, okay? So that's pretty much a common sense way of looking at it. If the market's going up, you want the put call to be mirroring it. It wants to be, going up also. If the market's going down, you want the put call to be falling with it. And if the market's going sideways or chopping, you kind of want the put call to be, dead flat even. So that's a couple tips.
Also, too, for some reason not all data feeds carry the put call ratio. For TradeStation, you can see here that the symbol on TradeStation is $WPCVA. I don't think they have it on eSignal yet, but you can go to the Let's
Yeah,
see.
they do. For if you have advanced charting, I think you do.
Oh, is it? Okay.
I think that's what somebody in the room said the other day.
www.cboe.com. Oh, yeah. Thank you. If you go to that website, cboe.com, you can get it for free. It's updated like every half hour or so. But that you just want to know where it is. So that's one of the things that we look at in the room, just to kind of decide, are we going to focus on the long side or the short side on this particular day. All right. Two of the things that we both really like a lot are the trend and the trend Q. The trend measures, it's a ratio of the up-down volume on the NYSE, and then the trend Q does the same on the NASDAQ. And basically what we're looking for is a question in a chart. Is it better in a chart? It's not. Basically, the reason I use charts is I'm just a very visual person, and I like to see the trend. If you can sit there and just watch the quote all day, and you'll remember where it started the day and where it finished the day, then that's fine. But I like to look at a chart because I like to see where it's trending, especially for the trend and the trend Q. So what I'll do, like here, like in the trend, like here's the trend. When the trend's rallying like this, that means the market is basically selling off. And on this particular day, on Thursday, 3/11, we had a really bad sell-off. When the trend's low and just consolidates all day, that means we've got a strong rally. So what happens is on days like this, if you see the market break out, it's safe to buy it because the up-down volume is supporting the move. On this particular day, if you see the trends rising like this to new highs and the market tries to break out, you short it because the selling pressure is actually increasing and it's a feint. Same thing here. So you can see the market is trending higher. It's the same thing with the trend Q. Okay, if you have a day where it's in a tight range and it's not really moving very much, it's going to support the move. However, if you've got a day where the trend Q is rallying, that means the selling pressure is slowly increasing, so the market is basically rolling over. So on days like this, you just want to focus on the short side. This will save you a lot of heartache in trading. When you have days where it is trending higher, you just ignore the long side. Exactly, yeah. So the trend is backwards. And when it's rallying, it's bearish. When it's falling, it's bullish. And if you think of it this way, when it's rallying, that means it's just an increase in selling pressure. So like this, that's an increase in selling pressure. And then when it's falling, that's a decrease in selling pressure. And so that's what you look at if you think of it that way. And these are really important because what will happen is if you're not aware of this, like on a day like this, if you're sitting there trying to just focus on the long side because you heard something on CNBC that's bullish, you're going to get stopped out on every trade. Whereas with the trend Q is telling you, hey, the selling pressure is increasing all day long. Ignore long setups and just focus on the short setups. And this is a really valuable tool to use in terms of knowing what side of the market to focus on that particular day. Now, one of the pet peeves that both Hubert and I have is that you're going to hear a lot of other gurus out there, or whatever you want to call them, tell you, or morons, as Hubert says, is that if the trend is over 1, it's bullish, and if it's under 1, it's bearish. Okay, it's such a misconception because what will happen is.
Use the wrong word. It is bullshit.
Let's say, okay, if it's over 1, it's bearish, and if it's under 1, it's bullish. If you think of it this way, okay, if the trend is at 1.20, okay, under that definition that you just got, that's bearish. Well, guess what? If the trend started off at 3, and now it's at 1.20, and that's the low reading of the day, that is very, very bullish because it is trending lower. So that's the whole key, is where is the trend or the trend Q right now in relation to where it started the day. And that is all that matters in the trend. It's not so much what it is, it's what it is compared to where it's been. So that's what you want to do. Let's see. Yeah, Malcolm, you can use moving averages. I mean, that would make the trend obvious. You could put like a 21-period exponential moving average on there. To me, I'll just watch candlestick charts. Hubert prefers to watch line charts. To me, I just like to see, for the candlesticks, I just kind of see, higher highs. It's just how I'm used to looking at them. But, you can add a moving average on there. You can use bar charts. The main thing is you just want to see, is the trend is it trending higher or is it trending lower? That's the main thing that you want to see. Now here's some tips basically on how to use these. Basically what happens is that what we're just talking about here is that, what's important is the trend. You've got, and this is why I chart these, because then visually I can see which way this market is trending. One thing to focus on too is, you'll see here is somebody had asked about longer term. If on a daily chart the trend closes over 2, basically that means that there was really extreme selling that particular day. What I've found is that basically 9 times out of 10 you're going to get a bounce the next day. No bounce, then the market is in deep trouble, because that means you're getting a crash type situation where the markets are just going to continue selling and selling and selling. And in fact, this is what they did in early July. We got a couple of 2.0 readings. The markets didn't bounce the next day, and the Dow's fallen almost 800 points since then. On the opposite side of the coin, if it closes under 0.50, that's an extreme overbought measure, and usually 8 times out of 10 the next day they're selling just to kind of relieve that overbought. So that's kind of how you use them on a daily basis. And Peter, for the question there, is this true for both the trend and the trend Q? For the trend, yeah, we use the trend and the trend Q exactly the same. I actually like the trend Q because seems like it's a little bit faster, but the trend is a little more powerful. So that's kind of how that works that way. Does that answer your question, Sarah, on that? And we'll be doing this on Monday when we do the live trading. You'll sit there and you'll watch us using these live and how we interpret the markets that way. All right, now the last piece of this puzzle is what we call the sector sorter list. And this is something that we just use to find the stealth moves in the market. Okay, and what I mean by that is if you look at this, now these are all kind of the major sectors. Some of these are repetitive. You're going to see like the Goldman Sachs Semiconductor Index, and then you're going to see the Philadelphia Semiconductor Index. The main thing is you just want to see how many of these sectors are green versus how many are red. And what will happen sometimes during the middle of the day, let's say the indexes don't move for 2 hours. They just chop in a real tight range. Well, what can happen is sometimes that, let's say, imagine that this sector list was, let's say everything down this way was red, okay? So what will happen, let's say that the markets are chopping sideways for 2 hours, and on the sector sorter list, half the sectors are red and half of them are green. Now the markets aren't moving, but then what you'll see is like 2 hours later, then it looks like it does right now, where you have about 80% of the sectors green and only 20% of the sectors red. And let's say during that time the indexes don't move at all. This is actually pretty common. What's happening is there's a stealth rally happening in the markets, is that while some of the indexes, there's more and more indexes that are going green, and then what happens is later in the day the markets break out. Well, we'll sit here, we'll watch the sector sorter list and know that the market is strengthening even though the indexes are just kind of chopping around. And when we see this, we know that the markets are going to rally later in the day, and we get positioned for that. So that's just a way we kind of, we want to look at the strength of what the markets are doing. Also, if I see the markets rallying, I want to see the banks, and you can see the banks right here, BKX. I want to see the banks and the brokers and the semis helping to lead the way higher. And on this particular example, you can see that the banks are here, the semis are here, and the brokers are here. Now, they're all green on the day, that's good, but when you get the really, really good rallies, those three indexes are going to be like in the top 6 or 7 sectors. Now, if you get a day when the market's rallying and you have, like, say, the banks down here, that's going to be a short-lived rally. The banks are the second biggest sector in the S&P. The largest is healthcare, by the way, but healthcare generally is market independent. The brokers are just a market proxy. So goes the market, so goes the brokers. And then the semis, they're such leaders. They led the markets higher. They can lead the markets lower. And that's why we watch those. So it's very important to watch what these different markets are doing, what these different sectors are doing. So this is how we use this. We want to watch the number of sectors that are green versus red at any given time. And one of the things that we'll talk about is, we'll sit there during the day going, okay, we're 70% green and we're 30% red. Well, that's what we're talking about, is that sector sorter list and where all the sectors are on that given day. And I talked about this, oftentimes while the indexes consolidate, the number of sectors going up or down on the day will change. And this is just giving you a heads up where the next major move of the day is going to be. So that's really, really important. You got to have a move. If you're going to have a sustained move, you got to have the brokers, the banks, and the semis. And so you'll hear us go, okay, the markets are rallying here, but the brokers aren't participating. And on those days, that's when we look for rallies to fizzle. So it's really important to know where those three key sectors are. I'm going to go back real quick. If you look at this, how it's sorted, I'm sorting it by this column here. Okay? And what I'm doing is I'm sorting this on a net percent change basis. So I want to see which sector is up the most in terms of a percentage points and which sector is down the most in terms of a percentage. The net change really doesn't matter, because if you've got a 1,000-point sector up here and a 90-point sector here, you want to really, what's important is the percentage, because a 1,000-point sector is always going to have a bigger net change, here, because that's that would be up 13 points. And this 90-point sector would only be up, less than a point. Yet those are similar moves in terms of percentage-wise. So basically what you're looking at is they're sorted on a net change basis. The strongest sectors are at the top. The weakest sectors are at the bottom. Okay, and then also we're going to talk about this for our gap plays too. Scott, it's basically what we do is it's just in Radar Screen, and we can give you you can just build that in Radar Screen. It doesn't take very long to set up. We can actually send you the workspace for it too. And basically when we're done with this, we'll send you all the workspaces we use for those of you that want them. So now, this is kind of how this all ties together. If you look on this chart that I'm sharing now, you will see all these indicators that I'm using, I tie together on one screen. And this is what I call my Radar Screen. And this is something that I can email to you guys that have TradeStation. But look at how I set this up, okay? Right here, I've got the trend. Okay? So, that's a nice arrow, isn't it? I can sit there and look at the trend and see how that's going. Over here I've got the trend queue, and I can see how that's going. And then right here I got the put call. Right here I've got the ticks, and you can see I've got all the lines with the alerts ready to go on the ticks. Right here I've got the ticky. And then up here I got the sector sorter list. So a lot of times what I'm doing during the day is I'm looking at what I call, if I sit there and go, okay, I'm looking at my radar screen, and right now the market's trying to head lower. All right, well, look at the screen. Okay, you've got most of the sectors red on the day. These are all red. You've got the ticks making lower lows here. So, we've got to here, and now we're down here. You've got the trend queue at its highs of the day, okay? We're at the dead highs of the day right here on the trend queue. The trend's holding up a little bit better, and then the put call sitting here at about, a little over 1. So you've got a market that's heading lower, but on this particular day, because you've got the trend queue over 1, you got the put call over 1, you've got the trend holding steady, the trend queue trying to sell off. Basically, you've got a day with a couple of mixed signals, but importantly, and on this particular day, the market basically sold off hard earlier in the day and then rallied later in the day. And some of the keys to that were a put call that was over 1. Yet, even though the trend Q was heading higher, you had a trend that was holding steady right around this level. I'm going to remove all these lines again. And you had a sector sorter list that started off mostly red and slowly got more positive green. So you can see here, like on this particular day, it started off like almost every sector was red, and then later in the day we had about a third of the sectors green. So that's kind of how we use the radar screen to gauge, how the markets are doing and how the markets are setting up, and most importantly, whether or not to focus on the long side or the short side on that particular day. On some days we focus on the long side and the short side, but on some days we're going to focus just on the short side. And everybody's going to ask, well, here's a buy signal, why aren't you taking it? And it's because of what the radar screen is telling us. And then, here's a short setup, why aren't you taking it? Well, it's because the radar screen is pointing to the long side, and we're just going to wait for the next long setup. So that's why we do it, and we do it based on our readings of the internal indicators like that. Anything you want to add on that?
All right, so here's what I'm going to do. I'm going to quiz you guys real quick. Just some pretty basic. What's our next slide, John? Gaps?
Yeah.
All right, I'm just going to go. All right, so hang with me for just a minute here, guys. All right, so do you see any value on S&P Premium? Yeah, it's good in the morning. That's about the only time it's good. All right, here's my slant on the trend. Okay, and I'm just going to re-explain it. All right. Introduction. All right, I'm going to use this one just because it's kind of a blank slide. All right, the trend. Here's how I think of it. The trend for me. The the trend is a measure of risk for longs, okay? Okay, it's a measure of risk for longs, okay? R-I-S-K. Okay, for longs, okay? So, if risk is rising for longs, which way is the market going to go? And you guys can give some input. I mean, just up or down? Is the mic working?
Yeah.
Okay. All right. Oh, I can't see it on this screen. Okay. All right. So that's right. So
take the unhighlight the marker.
I got you. So okay. So right. So if the trend is rising, the risk for longs is rising. Correct. So the market should go down. Okay. Now, if the trend starts, let's say the trend starts at like 1.5, okay? Its beginning reading is at, let's say, 1.5, okay? Let's say it starts at 1.5 in the morning, and it goes to, let's say it goes to 0.70. What should the market do? Should it go up or down? You're right, market should go up. Okay, all right, so those are the concepts. Make sure that you get these ingrained in your being, and you've got to know them. And now, here's what I'll do. Like, for on an intraday basis, I'll plot these bad boys on a line chart. So I know, I'm going to call this one the trend. Hold on. Call this one the trend. T-R-I-N, okay? So on my line chart, it'll look something like this. Let's say it starts out at a reading of 0.90. And then, let's say it gives some of this action, and then this action comes back up to 1, and then it comes back down. I will short the little peaks like this right here, okay? So that's how I use it. I use it on a line chart, just a little bit different. But that is just the difference between me and John. John trades one way, I trade another. It's the same core philosophy. I'm just a little bit smaller time frame than he is. It's really the only differences. And the most important thing that you can take away from this seminar, number one, is you've got to learn how to read market internals. I swear to God, if we could train somebody to read market internals the way me and John have done it over the years, it'd actually give us an opportunity to leave the trading room from time to time. But it's really hard to get someone to the point to where they instinctively know, just because you have to put in a ton of market hours, and you have to go back to like your radar screen. So, and just think of your radar screen like a pre-flight checklist if you're a pilot, or if you're a race car driver, it's your dashboard. Yeah, I just said it backwards is all. Yeah, Scott, my bad. I just said it backwards. And also, like for the ticks, I'll use it too. I mean, I was explaining the trend, and I gave him the answer to the tick. All right, so what you want to do is, let's say you're going, and all you're doing is you want to scan it, just like the dashboard in your car. Gas, good. RPMs, good. Coolant, good. Speed, fine. RPMs. Now, if you see the gas gauge dropping and the RPMs tacking out of 10,000, that's a bad sign, okay? So you need to really, really, really practice on market internals, reading trend cues going up, or trends going up, ticks going down. And if you have a conflict like we had Friday, we had the put call high, and we also had the trend high too. At the end of the day, the trend lost because the market rallied just a little bit. Friday was a nothing day though. But that's how I use the stuff. And then we're going to go over our next setups here on our next. We're going to pause real quick and save this one. So we have I'll field a couple more questions here, and then we're going to pause for 5 minutes. We're going to go over gaps.
I think it's already noon, so we may just take lunch.
You want to take lunch?
Yeah, I mean, because we said 12 to 1, and it's 12.
All right, so let's do this. We're going to pause here. We'll field some questions on what we've just covered, and then the very next thing we're going to cover is gaps, and it alone will pay for your attendance to the seminar that you're attending here. It is one of our number one techniques that we use every day in our trading room. You can use this one and actually be profitable. So, you guys got any questions? Okay, go ahead, Bradley. Question is, in your videos you have one on the TTM indicator. Yes, we will. We will be doing this live in this room Monday. You guys will actually be in a room with some of our members of our room, some of our friends that are in there. That room will probably be pretty full as opposed to what it's today. There's only 30 or 40 people in here. Monday, the members of our room will be in there where we're trading out real time, and we'll be talking about market internals while we're doing what we're doing. There'll be like 250 people in there. Let's see here. No. Oh, Scott, let me hold on. Let me see. No, we will go over indicators. That's going to be after lunch. Yeah, I'll go over the TTM indicator in detail during lunch. No, I kind of use the 2-minute chart default on a lot of the market internals that I use. It's just easier on my eye. John Dust does it because it's easy on his eye, the way he does it. Can you recap the indicators you did? Trend. Okay, all right, hold on. All right, so let's go. All right, so quick test. Put call. If the put call is going up, let's say, all right, if the market's going up, what should the put call be doing? I'm just going to go through a quick quiz here. If the market's going up, what do you want the put call to be doing? Correct. You want it to be going up. If the market's going down, you want the put call to be shadowing it and going down too. Now, it's not going to get wild gyrations. The put call's pretty calm. It'll just kind of trend with it. On the trend, the TRIN, if the trend is rising, what's the market doing? Correct. That's what it should be doing. And that goes along with the TRIN and the TRINQ, the trend and the trend Q, okay? If the trend starts at 3.0 and goes from 3.0 to 0.50, that's a good thing. You need to be long, okay? Do not get sucked into the thing that a lot of little gurus / idiots teach about, oh God, the trend's above 1, I'm bearish. It's a crock of bull, okay? The ticky. When programmed, what are the numbers for the tickies that you pay attention to? And what is the ticky? If the tickies explode to 26 or 28, what should you be doing? That's a buy program. Okay. Now let's say the ticks, which are separate from the ticky, which kind of lag a little bit behind the ticky. Let's say you have a gradual reading that starts at what does 500 mean on the tick? Anything? Okay, 400 on the tick. Nothing. That's right. Nothing till 600. So 6, 800, 1,000, and 1,200 are your magic numbers. It's just noise. And we're going to go over a tick extreme trade. Let's say you're long and you got long at like 600 ticks, and then all of a sudden, boom, it explodes to 1,200 ticks. What should you be doing? You had better be out of at least 3/4 of your position. You can still stay in some of it, but yeah, if you're long at 600 ticks and then boom, it goes to 1,200 real fast, you should be offering out to everybody, or at least offer out 3/4 and manage the last quarter. Okay. And you can potentially fade the trade, okay? That's your options. So I'm going to pause here. I'm going to let John field a few of these questions.
Oh, you got it covered, man.
Oh, okay. Right, never mind. He's cool. He's back there stretching on me. Anything else? I think that's it. Let me scroll back here and just see if you guys want to kind of go over anything else. Ticks, sector screen list, trend, put call, tickies, went over those.
The main thing too, guys, I think this is actually a good place to break for lunch too, because over lunch, if you guys think of any questions on this section, we'll start off the next section by answering those questions, because you want to fully understand this section before moving on. This is the most important thing that we do, the most important thing that we look at. It's simple, but if you can understand this, that'll give you a base and a foundation for everything else.
I don't really use the VIX. The VIX is supposed to be the new trend indicator, but I really don't pay that much attention to the VIX.
Joel, mainly how I use the VIX is it is a fast indicator, but it doesn't work as well as it used to. What I used to do is I'd watch it, because what would happen is on the OEX floor is if someone came in with a big order to hedge, the VIX would spike up, and when you'd see that, you knew that the market was going to sell off, and you could use that as an indicator to get short. I don't use it so much anymore intraday. I will watch it on a daily chart just to look for extremes, tops and bottoms and things like that. But for the type of trading we do, it's just not as important anymore.
Here's another one. Let's say you get a signal, you've got your own trading plan set up and established, and your signal fires off to go short when the ticks, or it fires off to go long when the ticks are 1,000. Should you take it? Yeah, not a real good idea. It's not a high probability trade. It may work out, but the odds of it working out are so low, it's not worth the risk. Anytime, as far as money management goes, that you are thinking about taking or placing a trade, first thing you should think about is your stop, number one. Okay? Your risk management. Before I put on a trade, I never put on my target first. It's always my stop is first. Entry and then stop. I could care less about the target. Because in this business, you get paid in this business to manage risk and recognize patterns. Okay? You're just like an insurance adjuster and a weather guy. That's all you are. You get paid to manage risk, which is an insurance guy, and then recognize patterns, which is a weatherman. That's all you do. That's all you get paid to do. That's it. As a hired gun that manages other people's money along with my own, that's all you do. That's all you get paid on doing. That's it. So those are the things that you need to get really good at. So as soon as you put an order in, you got to have a stop. And then you can place your target. But I'm always, as soon as I enter a trade, I'm thinking, how much can I lose? And if I'm up good on the day, let's say I'm up 70 points on the day, and then I see another trade going along, and it looks like a good trade, I'll usually pass on it because I'll be like, I'm already up 70 points. I could potentially lose 20, 15, 10 points here. I'm going to pass on it. Okay? So it's always risk first, profit next. I mean, it's just like a business. Any other business that I've built up and sold off or had acquired or just let it go to the wayside, it's a business. I mean, you gotta have. It takes money to make money, but you have to follow your policy, plans, and procedures. All right, so that's about it, guys. We're gonna break for lunch. Hold on just a second. Let me check and see. Anybody else got any questions? And we'll field some more questions too on when we come back from lunch. How long are we breaking for lunch, John?
We'll start again at 1.
All right, we're going to start again at 1. If you guys have any questions over what we went over, have them with you at 1 o'clock. We'll log back in at 1, and we'll start again. Our next thing that we'll be going over, which is very, very important, our gap plays. Okay? You're going to learn how we trade gaps, how to buy gap ups, how to short gap ups, when to pass on gap ups or gap downs, the raw data behind the statistics of the gaps. So you will definitely walk away with a plan on how to trade gaps. So that's it, and I'll see you guys after lunch. No, it doesn't matter. You guys can stay in here. You don't have to log off. Just stay in here. It's actually easier if you just stay in.
Yeah, we'll actually be logged on too. We just won't be watching the screen until we get back at 1 o'clock.
Yep. So see you guys back at 1 o'clock.